Hi, Dan Casey here. What's the best way to invest in the stock market? Mutual funds, ETFs? I'm going to go into the fees for both and why I hate mutual funds. Let's get started. Okay, so if you want to invest in the market, which is probably the best way to grow your money, of course, it's the riskiest also, but if you're young, it doesn't matter. But my clients who are retired or about to retire, it matters a lot. So, and also what matters because of my clients being in that demographic, there's a shorter time frame to invest, so fees matter a lot, and I'm very cognizant of fees. So, which is why I hate mutual funds. So basically, the only way to invest in the stock market is individual stocks, mutual funds, or ETFs. Obviously, there's other ways to get into the market, but those are the main ways beginners get into the stock market. All right, so let's talk about those three ways. Basically, individual stocks, pretty risky unless you can buy a lot of them to be very diversified. It usually doesn't make sense for the average investor. Then the next step is, and what we know most is mutual funds, right? So let's talk about mutual funds and ETFs. Those are the two basic ways. So mutual funds and ETFs. ETFs now have been around for a while. Early 90s, I believe, is when the first ETF came out. And now more money is going into ETFs than mutual funds. Mutual funds are basically, you've got a lot of individual stocks in here. Okay, and then there's a manager that's buying and selling. When should we get out of this? When should we get in? Trying to time the market. There's fees associated with that. And so, which is why mutual funds can be very expensive. But it's a way to instantly diversify into the market. If you buy one stock over here, an individual stock, obviously you're exposed to a lot more risk if something bad comes out about the company, maybe the accounting says they messed up. Whatever the reason is, you can wake up the next morning and lose a lot of money if you turn on CNBC, if you're into individual stocks, okay? So away from that is mutual funds, where you're instantly diversified. So you're buying a share of the mutual fund, but with that share you own a lot of individual stocks, okay? So there's a manager, they're buying and selling stocks, and there's a lot of fees involved in that. Now ETFs, same thing, you're in stocks, but an ETF is just a basket of stocks. There's no manager trying to buy and sell, trying to figure out if they can beat the benchmark. You're just sitting in a diversified basket of stocks. So if you buy an ETF that's, say, an energy ETF, then you're going to only own energy stocks if you think energy is going up. If you want to only own big blue chip stocks, you can buy an ETF where you're just holding big blue chip stocks and you're diversified, but you're going up and down with the market. So if you have time on your side, then you're probably would be fine. Again, they've got ETFs where you can buy just the highest dividend stocks. So this would be kickoff dividends. There's an ETF for everybody's purpose, and you can buy a bunch of different ETFs, so you're very diversified and very inexpensive. Okay, mutual funds the fees can be 1%, 2%, 3%. And in about a minute here, I'm going to take you back to my desk and show you how to figure out where the fees are for your mutual fund. 1%, 2%, 3%, 4% in mutual funds, because they're buying and selling. You're paying commissions there. ETFs, again, because you're just holding them, these are very, very low cost, usually like 1/10 of 1%, 20th of 1%, so very 0.20%, very, very low in fees, okay? If you've seen any of my other videos, you'll see, usually if you're dealing with a commissioned advisor, a broker, he might call himself, him or she, a registered representative, they're going to probably put you in mutual funds, and they're going to be a commissioned mutual fund. So that's how they get paid. It trickles down, okay? So you're probably looking at, it's either an A, B, or C shares. And to be honest with you, I'm not even sure B shares are around anymore. When I first started in the business many, many, many years ago, almost 20 years now, B shares were around, but they're so high in fees and they just make no sense that they're eventually were fading away. A share, you're paying an upfront commission, usually between 5 and 6% upfront commission, and then there's going to be a fee. Usually it's about 0.75 to 1% a year to be in the A share. C share, you're paying a big yearly fee, but nothing to get into it in the front. All right, so mutual funds can get complicated because there's also you can share that upfront commission I just told you about, that 5 to 6% can become lower if you put all your money into one mutual fund family, and it's called breakpoints. If you put more and more money with one mutual fund family, then that upfront commission can get lower. But one mutual fund family usually doesn't have the answers to all the different markets out there. For instance, American funds, very good at value companies, buying companies that are in value and not necessarily growth, although they do have one growth fund that's pretty decent. Fidelity, they have their niche. Vanguard, they have their niche. So it doesn't usually make sense to put all your money in one mutual fund family. We talk about diversification all the time, right? Well, you shouldn't be all in one mutual fund family. And then the fees, again, are very high. ETFs, you can still diversify and be everywhere you want because there's an ETF for every need that you have, okay? So those are the two basic ways to get into the stock market. Now, come with me. I'm going to show you some clips and some documents that will show you exactly the fees that you're paying in mutual funds, because unfortunately, they're not all in the prospectus. The ones that are in the prospectus are hard enough to understand, but the ones that they don't even have to show you are even more complicated and can be even higher. So let's talk about that. Follow me. Okay, so this is the video I wanted to play for you. It's an interview with Tony Robbins. It's regarding his book that just came out. I think it was about last year. It's his first book in 20 years. And what he did is he went around and talked to a lot of finance experts. And basically what he found when he talked to them about mutual funds is the poor performance, high fees, and the collection of acronyms that are just around to confuse investors. So this is what he found. Let me play the video for you.
Here's one for you. Another lie. 96% of mutual funds, 96% don't match the market, meaning they're not the same as if you just bought what's called an index. An index is just a piece of all the biggest companies, for example, the S&P, the Standard & Poor's. You don't have to spend any money to buy that index, like 0.20%, not 3%. And you get the same companies, Apple, all these great companies. 96% of mutual funds over a 10-year period don't match that. So what does that mean? It means only 4% succeed in a 10-year period, and the 4% is always changing. So let me help this for anybody listening. So they go, oh, math, no, what do you mean?
What is this math business?
So let me show you. Watch this. I'll give you an example so these numbers come to life for you. 96% of chances you're going to pick the wrong mutual fund. You only got a 4% chance of succeeding, right? That's majorly gambling. So let's say you play blackjack, and anybody's played blackjack, it's 21, right? And you get two face cards drop on 20 in front of you, 21. And some inner idiot in you says, hit me. You have an 8% chance of getting 21 with two face cards. You have a 4% chance of picking the right mutual fund.
I think I'd rather take the 21.
So, but what I show you is you can get the market. You can become an investor in American business and not have any of those fees, almost nothing, 20 basis points, for example, with a company like Vanguard. And now you get to grow with all.
And he's talking about ETFs there.
In recessions, depressions, they've always found a way to rebound, and those are the people who have done well. Equities have done extremely well.
That was Tony Robbins talking about mutual fund costs, and of course, when he was talking about buying just a basket of funds, he was talking about ETFs there. When he said 20 basis points, that's 0.20%. Kind of what I was saying before. So here's an article from Forbes entitled "The Real Cost of Owning a Mutual Fund." So basically, okay, so look right here, the expense ratio. That's what anytime you look at expense ratio, talk about expense ratio, that's what's in the prospectus, and that's what's widely advertised and talked about. But those are not the only costs, and that's kind of the purpose of this article. The next one is transaction costs. Because the mutual fund manager is in that fund buying and selling, and because some of these are, billion-dollar funds, there's serious transactions in order to buy and sell and do what they're telling the investors they're doing. They're trying to beat the benchmark. They're trying to beat the market. This study done by right here, Edler, Evans, and Cadlick, found that the average is about 1.4% added on to that expense ratio for transaction costs. Now, what are we talking about here? Well, the first type of transaction cost is the brokerage commissions. That's, obviously them in there buying and selling and the commissions in order to do so. Okay, they're not paying commissions like you and I would at Fidelity or whatever. But again, when you're talking about such a massive amount of money, it does start to add up. Okay. The second transaction is even more difficult to estimate, but it's the market impact cost. And really who made this really well known is John Bogle, who started the Vanguard funds, and his group of avid followers called the Bogleheads. What this cost is basically the stock market is supply and demand, right? So when a mutual fund company goes and buys $1 million worth of shares of a particular company, they affect the price. You cannot just go to the market with $1 million and buy Apple, say, and not affect the price. It's supply and demand. When you go in with $1 million, you affect the demand. You increase the demand, which increases the price. So you may get the first, 10,000 shares at a certain price, but the next 10,000 may be, slightly more, and so on up to $1 million. So you affect the price, and you don't get the price you think you're getting. That adds to cost. The final transaction is called the spread cost, and this gets a little bit more technical. I don't want to get too much in the weeds, but when you're buying individual stocks in the stock market, you're buying it at one price and selling it at another. It's called the bid-ask spread. And really this comes into play when you're dealing with international or less liquid funds. So we'll kind of skip over that one right now, but basically there's just a small cost in that. Tax costs. Now, many investors, obviously, when you're dealing with IRAs or Roths or any kind of tax deferred accounts, you don't have to deal with tax costs. But if you're doing it outside of these particular plans, then you've got to deal with costs. So what this is about is, obviously, if you're not in an IRA and you're buying and selling stocks, you're incurring short-term capital gains and probably some long-term capital gains, depending on how much they hold on to the stock. Usually in a mutual fund, they don't hold on to it very long. So it's a large percentage is that short-term capital gains, and that's taxed at your regular tax rate. And when you get 1099s, when you invest in mutual funds, you'll see that on there. So what happens is, say they're buying and selling all year long, January, February, March, April, May, and you decide to invest in the mutual fund in November or December. Well, they'll issue the 1099s and you'll have to pay taxes on shares of mutual funds and trading in that mutual fund that you didn't even participate in. That happened earlier in the year. So, number one rule is before ETFs even were very popular and I was investing in mutual funds, I would never get in at the end of the year, or you need to call the mutual fund company to find out when they're going to distribute those gains. So that's something to keep your eye on, and which is why another reason I don't like mutual funds. That cost can be another 1 to 1.2% a year here. Cash drag. Okay, so this is a lot of mutual fund companies will keep a fair amount of money in cash to handle redemptions or handle people wanting to turn in their mutual funds for cash. So they don't have to sell out of stocks. If it happens to be in a down market, they'll keep a fair amount of money in cash. Well, you're paying all these expenses and the expense ratio on that cash, so it's not working for you. Now, obviously, when the market's going up, that's going to hurt you badly. If the market's going down, that actually is in your favor, okay? Obviously, if you're sitting in cash, then you don't lose that money. So, again, it's just a bad thing if the market's going up, but something to keep aware of. Soft dollar cost. This is that quick pro quo that, they'll have certain brokerage firms trade for them, and it's just not a good thing. Advisory fees. If you're dealing with a commissioned advisor, then you're going to be paying obviously a commissioned to get in there. If you're dealing with a fee-based financial advisor like my company, then there's obviously going to be a fee above and beyond all these fees I'm talking about. But that's exactly why I don't get into mutual funds. If you're paying my fee to pick the best ones and to decide when to get out and get in, why would you pay all those costs inside a mutual fund? That's why I go into ETFs when you're only paying, 0.10%. All right, so if you're dealing with a fee-based advisor and he's got you in mutual funds, I'd run for the hills on that one. So here's the cost ratio. If you're dealing with a non-taxable account, you're looking at about 3.17% fees. Taxable account, about 4.17 is the average for a mutual fund when you add in all those costs. Now, keep in mind, folks, 4.17 is the average, which means half of the companies are more than that. Okay, same with the 3.17. Half of the companies are going to be above that. Folks, it's not what you make in the investment world, it's what you keep. You've got to be aware of fees, and that's something that I am very diligent on. I do not want to pass on excessive fees to my clients, and I'm always looking for the best way to get into the investments for my clients without killing them with fees. Okay, I wanted to jump over real quick to the FINRA site. This is the regulatory body for financial advisors and anybody in the financial industry. If you Google FINRA Mutual Fund Analyzer, you'll come to this site here. You can put in just about any mutual fund or ETFs in here and figure out what the fees are. Now, these are only going to be the expense ratio fees, not the other fees I discussed in that Forbes article. So, for instance, I already typed in one particular mutual fund, and ABICX is the ticker right here. If you click Show Results, you type in the mutual fund right here. This will go through and tell you exactly what the fees are and how much you would lose and gain if you put in some basic rates. What I want to show you is, let's scroll down to, this is probably a good chart here. You can see over a 10-year period in this particular fund, you're paying $2,472 with a profit of only $30,137. Now imagine if you didn't have those fees, you'd have, almost double that amount. Here's the annual expense ratio. This is that just the expense ratio, 2.15%. So it doesn't even include those other fees that I talked about in that Forbes article. Let's see if there's anything else here. No, so you can run reports and compare, but that's the stuff you guys got to be aware of, are these fees. And that's what was only on $10,000. Can you imagine if you actually invested, a good chunk of your retirement money in this particular fund? Let's see how ugly it gets. There you go. In 10-year period. So say you invested in age 55 and you wanted to retire at age 65. You're going to be paying $24,000 in fees. See right here, $24,000 in fees just to be in this mutual fund to eke out a gain of $31,000. Okay, so this is what I'm talking about. I hope this helped, guys. If you have any questions about mutual funds or the fees, post it in your comments. Click to subscribe to my channel here, and you'll be updated every time I update or put in a new video. Thanks, everybody.